Welcome back to Archie Spencer FX. Today you guys are in for an absolute banger. We're going to be giving you guys a range masterclass, how to trade a range, how to mark up a range, and exactly how to execute where your stop loss is going to be and where your take profit is going to be. I'm going to give you the full strategy that I use to trade Bitcoin when it's inside of a range, and I'm going to show you exactly how it's done right here, right now. So stick around to the end, and by the end you are going to be a professional at trading Bitcoin when it's inside of a range. Now make sure you hit the like button, subscribe, and leave a comment for what you want the next video to be. So first things first, when you're range trading is of course you need to mark out where the range is. I know it sounds obvious, but it is very important how you do this. So for this specific strategy, I like to do it on the 1 hour chart, but you can chop and change this around. You can do it on the 4 hour, you can do it on the daily, but I just find the 1 hour works the best for me personally. Trading is all about whether you can be at the charts all the time. Completely depends on whether you're a full-time trader or whether it's something that you're doing on the side. So really important that you get right what suits for you. So for me personally, as a full-time trader, I like to do it on the 1 hour because it gives me lots of entry opportunity, lots of time to trade, whereas if you do it on the daily, it's going to be a lot better for someone which is only trading for an hour or 2 hours of the day. So to mark out that range, you use this tool here, which can be found on the side. It's the Fibonacci retracement. Now when you use this tool, you want to have the settings so that you've got the 0, 1.2, minus 0.2, 0.25, 0.5, 0.75, and the 1. So these aren't all so important. The 0.5 we don't really use, but you can use it with this strategy, but I'll come on to that a little bit later on. But the 0.2, which is our extreme down here, and the 1.2, which is our extreme up the top, that basically is our range outside of the range. So we allow price to move a little bit outside of the range. You don't want to be autistic about it. Ranges, and they have to have a little bit of movement inside of them. It's very simple. So make sure that you've got that set right, and then we will get into the video and I'm going to show you guys exactly how we do this. So first things first is you want to look for at least a 75% retracement of the first move. So that would be here. Once we see price come back past there, that's our first indication that we are coming inside of a range. So we have the first leg up, we have a retracement over 75%. As we can see in this one, it was way past 75%, past 100%, and probably more like 120%, which is really nice confirmation that we are going to drop into a range. Very important. Once we have that, we then look for price to come up and have a market structure break. So where we have that first is around this area. So we've come up, and then this is our market structure break level along here. So we can trade before this. It's not ideal. You're better off waiting really for the trades to come off the bottom or off the top, depending on which sets up first, to allow you much better conviction when you're entering into the trade. So the way that the system works is extremely straightforward. So from the 1 hour chart, you then drop down into the 15-minute chart. So what you're looking for in the 15-minute chart is we've got our premium and we've got our discount. So the discount's from the 0 to the 0.25, and the premium is from the 0.75 to the 1. So mark these up in red and green if it helps you see the chart a little bit clearer, and that is where you're looking to take the trades. Do not diddle in the middle. No trades taken in the middle. Leave it alone. Just don't get involved with it. Sometimes you can take profits to the 0.5, so you could look to have 2 take profits. You could have one at the 0.5, and then you could also have one down at the other extreme as well. But do not be placing trades in the middle of a range. You will get chopped up and you will lose a lot of money. It's very simple. So when you see price come up, you're looking for fair value gaps, and you're looking for fair value gaps to get ran through, so inverse fair value gaps. Now that is what this purple box here represents is our fair value gap on the way up. We can see prices ran through it, and we're looking for a retest back to that fair value gap. So we create it, we break through, we're looking for a retest back to it, and we put a limit order on the edge of the fair value gap. So this is very good for dealing with fees, because you get a lot of fees when you're dealing with market execution, but when you're dealing with limit orders, you can reduce how much fees that you pay, reduce the spreads that you pay. So it's a very good way of getting into the market, and this strategy is absolutely perfect for it because it gives you lots of time. We can see here we've had probably about 45 minutes from where price broke through to then returning and touching into the fair value gap. So loads of time to place his limit order and really good execution. Stop loss quite simply just goes above or below the previous high or low, and then your take profit, you are targeting the other extreme. So that will either be the 0.25 or the 0.75, depending on whether you're buying or selling into the range. And of course, if you draw this range the other way around, it's also going to be the other way around, but it's either the 0.5 or the 2.5. And like I said earlier, you can set, if you want, you can take 2 entries and put one take profit at the 0.5 and one take profit at the other far extreme, which, as you can see here on this second trade, it would have actually been very beneficial for you to put the first take profit on the 0.5 and second take profit at the full extreme. Another thing that you can do is once you hit the 0.5, you can move your stop loss to break even. This is another good way of managing your risk and making sure that you're limiting how much capital you're exposing every day. So for this trade, we can see the fair value gap was made here. So when you get more than one fair value gap in a row, like we did here, so we got fair value gap, fair value gap, fair value gap, mark them all up as one. Don't be marking them up as small little individuals. That it's one. It is one fair value gap. It's one imbalance that needs to be infilled. So the reasoning behind inverse fair value gaps is if a fair value gap is created, it should hold. It shouldn't get broken. If it gets broken, then you're looking at the continuation isn't there, and you're looking at a reversal, a mean reversion. So we use it for our mean reversion trading. So again, here we can see fair value gap created on the way down, then we've tapped into the extreme, we've broken through, we've retested back in, and we've come up to the 0.5, and then we've hit our stop loss. And then you can go again after that. You don't have to lose one trade and then stop there. With this, you're looking at very, very big numbers. So if you've got to enter 1 or 2 or 3 times for each trade, you're still going to be making an awful lot of money. So as we can see here, we've now pulled in, we've created the single fair value gap here, we've broke through, retested back in, limit order set, stop loss goes below the previous low, which is there, and then we are again targeting the other extreme at the top, and we can just literally just keep on trading this. It does not stop. So again, fair value gap created here. Now we've got more fair value gaps here, but we didn't create one between these candles, so that means you just take the first one that gets ran through, price pulls back to it, stop loss goes above the previous high, and we're targeting the low. So as we can see here, we've just done 1.59R, then we've done -1R, so we're up 0.59, then we've got a 3.63, then we've got a 4.6, then we lose a trade, then we lose another trade, and then we hit an 11.91R, which is just fucking incredible. Lose a trade, and then we hit a 4.16, and then we hit a 2.05, lose a trade, and that is pretty much done. But when price breaks out, this is very, very, very important. So as we can see, we've done loads of trading in here. Price then breaks out of the range on the 1 hour chart. As soon as you get a close outside of the 0.2 or the 1.2, this range is no longer valid at that time. We need to wait for price to come back inside for us to be able to trade inside of the range. So this is another slightly different method which you can use. So when price breaks back inside of the range, you can wait for it to break the 0 or the 1, which are the bottom and the top of the 2 extremes, and then you can wait for a retest back to it, stop loss below the 0.2 or the 1.2, and then you're targeting again the extremes. And then price broke out again, held above, and then this time we've entered as soon as price is broken through the 1.2 the 1, sorry, and then we've got out at the 0.25. So there's 3 different ways that you can trade the ranges, each one there. So we've got the first one, which is the inverse fair value gap. Then we've got the second one, which is where it's come out of the range, comes back into the range, we wait for a retest back to the 1 or the 0, and then we trade it back up to the extreme with the stop loss below the 1.2 or the 0.2. And then we've got the other option, which is my least preferred option, where as soon as you break through the 1 or the 0, then you enter in straight away stop loss above or below the 1.2 or the 0.2, and then you're targeting the extreme again. So really brilliant strategy. I use this so often, and it makes up such a massive proportion of the money that I earn on the markets through Bitcoin. We can see here we've taken 1 2 3 4 5 6 7 8 9 10 11 12 trades in the space of 31 days. So we're looking at realistically a trade every other day. But if we look at how much of this time we've spent inside of trades, it's absolutely exceptional. I'm sure if you add all of these entries up, including the losses, you're looking at around 15%, which for 1 month's trading, and this is just a single range trading strategy on a single currency pair, well, cryptocurrency. So the amount of money is just endless, and this again is just risking 1% per trade. If you want to risk 2% per trade, then you're looking at double those numbers, which is huge, absolutely massive. And considering that when you're trading, all the markets, they spend roughly about 70% of their time inside of a range, especially on the 1 hour chart. It is one of the most used strategies that I use it all the time, so often. And you can take this not just on Bitcoin, this is where I find it is most successful, but you can trade this on forex pairs, you can trade this on gold, you can trade it on other cryptocurrencies, you can trade it on commodities. You can literally take this strategy anywhere. The power of a range and an inverse fair value gap is absolutely incredible, and I recommend all of you go away, watch this video 10 times over, take it in, go and do your back testing and take it live, and drop me some messages and let me know how you get on, because it is a really powerful strategy, and it's one that I was very hesitant to give away on a YouTube video. But it's definitely worth going and testing out, and just let me know how you get on. I think you guys will have a really good time with it. Well, if you like the video, make sure you hit the like button, subscribe, and leave a comment for what you want the next video to be. Alright guys,